Every financial crisis is sold as a surprise. It's an unexpected collapse, a once-in-a-lifetime event. Experts appear on television, shaking their heads, telling us no one could have seen it coming. And yet somehow it keeps happening. Different decade, different excuse, same outcome. Banks survive, debt grows, the public pays. So here's the uncomfortable mystery. If financial crises are accidents, why do they follow the same script every time? Tonight, we're not asking what went wrong. We're asking who benefits when it does. Setting the stage, the hidden architecture to understand why crises repeat, we have to step back not to one crash, but to the system that makes crashes inevitable. Modern economies are built on credit, not money. Almost every dollar in circulation begins its life as debt, created by banks when loans are issued, not when governments print cash. This system didn't appear by accident. In the early 20th century, central banking evolved to stabilize economies after frequent panics. The promise was simple: smooth the cycles, prevent collapses, protect the public. But stability came with a trade-off. Control of money creation shifted away from democratic institutions and toward financial intermediaries. Over time, this created a system where growth requires detente, debt requires expansion, and expansion has consequences. Origins: the birth of the cycle. The first major clue appears in the late 1800s and early 1900s. Banking panics were common. Depositors rushed banks. Credit vanished overnight. Economies froze. The solution was centralization. Central banks were given extraordinary powers to lend in emergencies, to stabilize markets, to act as lenders of last resort, but there was an unspoken assumption baked in. Crises would still happen. They would just be managed differently. Instead of letting weak institutions fail naturally, central banks learned to absorb the damage of fond by expanding credit even further. This created a paradox. The cure for debt-fueled instability became more debt. And that's when the pattern locked in. Rise when growth became leverage. By the mid-20th century, debt wasn't just a tool, it was policy. Governments borrowed to fund wars, welfare, infrastructure, and growth. Corporations borrowed to expand faster than profits allowed. Households borrowed to maintain living standards, wages no longer supported. And banks earned interest on every layer. As long as asset prices rose, the system looked healthy. Debt was rebranded as opportunity, but leverage cuts both ways. Each cycle followed the same rise. Cheap credit asset, inflation, speculative behavior, overconfidence warnings were always dismissed as pessimism, because stopping the cycle would mean slowing growth, and growth had become politically non-negotiable. Breaking point: the crashes triggered crises don't begin with collapse. They begin with tightening. Interest rates rise. Liquidity shrinks. Debtors struggle. The weakest links fail: first over-leveraged firms, fragile borrowers, speculative assets. Then panic spreads. Credit freezes. Markets seize. Confidence evaporates. At this moment, we're told the system is broken. But here's the crucial detail. The rules change during the crisis. Losses that were supposed to be private become public. Risk is socialized. Failure is forgiven selectively, and that's not a bug. It's a fallout: who pays, who survives after every crash. The same outcomes repeat. Banks are rescued. Markets are stabilized. Debts are preserved. But wages stagnate. Public debt explodes. Inequality widens. Why? Because the system is designed to eliminate debt, ES designed to protect the structure that generates it. Crises allow bad loans to be transferred to balance sheets of central banks, market discipline to be suspended, regulations to be rewritten under emergency conditions. The public absorbs inflation, austerity, or higher taxes, often years later, quietly. And once the dust settles, the cycle resets. Failed fixes: why reforms never stick after each collapse. Reforms are promised, new regulations, stricter oversight, safer systems. But look closely, and you'll notice something strange. The core mechanisms never change. Fractional reserve lending remains. Debt-driven growth remains. Too big to fail institutions remain. Reforms address symptoms, not structure. Because altering the structure would mean confronting an uncomfortable truth. The economy no longer grows without periodic crises. Crashes clear debt selectively. They restructure power quietly. They justify interventions that would never be accepted in normal times. In other words, crises have become functional, Modern parallels, the pattern repeats. Fast forward to today. Global debt is higher than ever. Interest rates fluctuate between emergency lows and destabilizing highs. Asset bubbles reappear, different names, same dynamics: housing, stocks, sovereign debt, shadow banking. Each time, the language is identical. This time is different. This is temporary. This is under control. But the data tells a different story. Crises occur more frequently, not less. Recoveries rely increasingly on monetary intervention. Central banks hold unprecedented influence over markets, though. System now requires constant management because instability is baked in. The reveal design, not accident. So why do financial crises repeat? Not because no one learns, not because models fail, not because warnings are absent. They repeat because the system rewards short-term expansion, shields large institutions from failure, and shifts long-term costs onto the public. Crises aren't random shocks. They're pressure releases. A way to reset leverage without dismantling the machine. Takeaways: what this means. Takeaway 1. Debt-based systems naturally concentrate power unless actively constrained. Takeaway 2. Stability built on intervention creates dependence, not resilience. Takeaway 3. When failure is removed from markets, risk doesn't disappear, accumulates. Warning: the open question: every cycle requires more intervention than the last. Every rescue makes the next collapse larger. The real question isn't if another crisis will come. It's whether the tools used to stop it will still work or whether they'll become the crisis themselves. Call to action if you want to understand how money really works beyond headlines and official explanations. Because once you see the pattern, you can't unsee it, and the next unexpected crisis may already be underway.